Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlatnik, and today it is my pleasure and a privilege to welcome Dan Krzyzanowski. Hi, Dan.
Hi, Mike. Great to be here today with y'all.
Thank you very much for coming on a podcast. You hail from Austin, Texas. You've been a passive investor in self-storage and many other asset classes in real estate for many years, and you have some active involvement. We'll get there in a second. You graduated from Wharton School of the University of Pennsylvania and Thunderbird School of Global Management. And so tell us a little bit about your family first, and then a little bit about your real estate venture or adventure.
Sure, absolutely. And great to be here once again with everybody this afternoon. Originally from Scranton, PA, so I know you spent some time on Binghamton, the I-81 corridor.
I went to school in Binghamton, so I've gone through Scranton many, many times.
We may have shared a beer in the 90s. You know, I remember Good Time Charlie's among some other ones that we snuck our way into. But yeah, Binghamton was the big world when you're leaving Scranton back in the day. So but yeah, you know, right place, right time. Like many of us in my generation, my dad was a high school principal. My mom was a social worker, very down the fairway, do your job, get your pension. Whereas my grandparents' generation, very entrepreneurial in every way, shape, or form. So you kind of with these two sides, as you shared, you know, led me to Wharton, went from Philadelphia, spent some time overseas in Spain, and then found myself trading for Merrill Lynch on Wall Street. So a great way to start the career. And as my product became commoditized, I joke if I did what I did on the debt side, we'd be on my island right now, but I probably would have caused a financial crisis. So, you know, good for the soul, not as much the pocketbook. And like many of us, you know, already in sweatshirts and hoodies in the Northeast, got a little sick of the winter, moved out to Thunderbird for my master's, and thereafter was with General Electric. So I joke with my younger friends, colleagues, mentees that this was the Google of your days. This was the top company everybody wanted to work for.
That's right. G used to be the shining star. Jack Welch and the whole School of Management. This was one of the best places to go through if you wanted to be a corporate executive or a successful businessman in general.
Yeah, and it was great. And we still had, you know, Jack's halo around all the training and everything we did. And like anything, I just felt right place, right time, working in some of the capital, some of the real estate businesses, you know, down in Mexico City, acquisitions on the West Coast, and just kind of dumb luck at the time, had a first taste of Austin. For those familiar with GE, we have a real estate and aviation division, and picture them getting together. And the net result was the airport real estate, specifically air cargo ports, where say UPS would fly out of and drive, you know, move their goods. And this was a cool experience, you know, back in 07, 08, spent a lot of time in South America, led to a few good wins for the company. And, you know, for me, it was a very tangible view of real estate on the commercial side. So, you know, fast forward a little bit, shifted in a few other capital businesses at GE. And then for, you know, personal reasons, my wife was from Mexico. So, you know, be a little warmer once again, we found ourselves back in Austin in 2011, a good decade or so before everybody else. And, you know, from here, like many of us, I'd say the alternative scene, whether it's being weird, the music, or, you know, frankly, as an investor or an entrepreneur, it feels very natural in Austin. So I was doing the equivalent of crowdfunding before the Jobs Act, was co-best man in a wedding, which led me to my first passive real estate investment. And one of my light bulb moments was learning, just as, you know, Mark Halpin and many of your great guests recently, that this world of self-directed IRA and solo 401k. And this was really between being tied in with different fintech and real estate tech, prop tech companies, coincidentally self-storage. This was kind of the kickoff in the early 2010s of me in Austin that's led me on this journey.
Yeah, I appreciate that great little bit of a journeyman story. So that's wonderful. And Austin is a great place. It's kind of it's got the best of the left coast and the right coast, and it's got no income taxes of California, no income taxes of New York. So from that perspective, people love it.
No, it's great. We're very happy and fortunate to be here.
That's awesome. So tell me a little bit about what are you working on right now? What are the opportunities you're exploring? Where do you see sort of the looking beyond the high interest rate environment? Where do you
Sure.
see great opportunities, and what are you investing in today?
Yeah, I mean, what I like today are the secondary cities in Texas. So by secondary, I mean outside of the triangle, not Dallas, Houston, San Antonio. Funny enough, Austin's not part of the original triangle, but nowadays people consider it. So you're kind of in the secondary-ish, or say the next 10 or so cities that would be mentioned in the greater metro areas. Some obvious ones smack dab between Austin and San Antonio is New Braunfels. There's San Marcos. You can draw a ring around both the Dallas Metro and Fort Worth Metro. Many opportunities there. And as you referenced, I mean, Texas, you're seeing migration not just from the coast, but also from within Texas. Folks are saying, you know what? There's too many Teslas. Once there's more Teslas than tacos, I'm out of Austin. And they'll migrate a half hour to the north, to the south, otherwise. And, many of us, I spend time in New York in the city. Folks coming to Texas the first time, particularly with the family, may not be familiar with the real estate market, which school, how everything works. No surprise they don't want to live in Class B or C. So in the interim is this nice Class A housing. So I think folks, whether you're coming with a family, you're in the third stage of your life or right out of school, as I call them, these secondaries and cities are pretty attractive to, continue your journey in life.
Yeah, it's pretty interesting. I've been told this about Austin: you can come and visit, but please don't stay.
Well, Steve Adler, our old mayor, he jokes. He says the problem isn't me or my friends; it's everybody that got here in 1979, and he says that's because he came in 1978. So every year we say it more and more, and I think there is some justification to it. I mean, kind of the shared domain knowledge is a little bit less. Myself personally, I made it a goal my first year in Austin to join Leadership Austin, which, as it sounds, you join different folks, professionals in the community, not just your micro segment. So not just tech, not just corporate, not just government, but you get all together. So, I would say, a challenge for folks coming to any metro is to really embrace it. There is a great podcast called Growth Machine. It was done this summer by our local PBS KUTX. It's phenomenal. You can do it in a round trip from Austin to Houston, about 6 episodes, but it takes you back for the last 100 years, primarily from a real estate side, but why Austin is Austin. And then it dives deep into some fun stories. And, I would even argue a lot of folks that moved to Austin probably don't realize that our current mayor was our mayor in the 90s also. So
That's interesting.
yeah, kind of little big things like that would be my soft ask to folks that want to embrace the community, particularly if you are going to move here.
Makes sense. So again, specific asset classes that you're investing in. Are you investing in multifamily housing? Are you investing in storage? What's interesting? Obviously, demographic trend will continue, that inbound population will move into various parts of Texas. Obviously, Austin benefits from, let's just call it blue state migration. And then you got the folks that are more conservative that go into typically Dallas, Fort Worth area. Politics aside, Texas is growing. Like, for whatever reason, it's growing for many. There are enough drivers. People who are cold want to move south, and people who don't want to pay taxes, they want to move to Texas. So those trends will continue. So where do you see best opportunities today? Is it ground up construction? Is it value add multifamily? Is it what class A, class B? You mentioned tertiary cities, not primary cities. And why? Why the primary cities are too expensive? I'm just curious why you like more tertiary cities, and what asset classes, like storage, industrial, what else?
Yeah, it'd be more secondary cities. So, especially Texas, I think industrial is always a solid play. I mean, as you said, politics and such aside, we have Mexico below us, we have ports, we have a lot of military. Goods are going to move, and they're going to need a place. So I feel, particularly the triple net industrial, I think we're in a pretty good place. I think you need some serious macro events to happen where an industrial would be decimated. So that's an industrial. Storage, I've been a fan. I was lucky enough to be the first guy with the little gray hair at Sparefoot well over a decade ago. Got to meet, the folks, the top 100 owner operators. One gentleman who I consider the top COO, i.e., became friendly, invested with him, introduced him to a lot of folks. He's since sold to one of the REITs. And what I realized about storage, death, divorce, dislocation, there's a new kind of fifth or even sixth D out there. And I think one of them is just decluttering. And that's easy to think about in the world of COVID. But even now, it's tough, especially a city like Austin. Let's talk about a primary city first, Dallas. To get the space you want may not fit your budget these days. So keep the math simple. An extra bedroom might cost $1,000, whereas a storage facility, even if it's a 5x5, might cost you $100. So whether you're shifting out your winter clothes for summer clothes, skis for surfboard, whatever you want to call it, folks are in their place a little bit more. They kind of want some space. They don't want to feel like they're cluttered. And, if you read the headlines, there's different Ds that come up where storage has gone from 7% to 11% of the population. It's becoming a right of life. And, even at the college level, you might have 4 or 5 fraternity brothers together. So it's not a big revenue play for the summer, but they're actually touching storage as a product very early in their life. So I think a lot of folks are getting used to it from that standpoint. Working backwards a little bit, I think storage is a natural extension of multifamily. So, some of these old tertiary towns are becoming secondary. Some of these secondaries, over time are going to be kind of close to primary here in Texas. So, I just look at the Austin, San Antonio corridor, San Marcos, New Braunfels. This is great because let's say one spouse works for Dell, one works for USAA. You have an equal commute, maybe less than an hour. So folks coming from New York, I used to take the train from Connecticut at times, or LA. It's kind of a reasonable deal, especially if you're only going to the office a few days a week. So, with that, I think whether it's just, a nicer pool or frankly, pickleball courts, folks want to feel like they have very modern amenities. So from that standpoint, I think there's, supply is going to come on a little lumpy due to energy and water rights. So I feel there's a little more 1 year than kind of nothing for a year or two and then bump up a little bit. And I think we're going to see this over the 2020s. So I'm still really bullish on development, clean product, new product, supported by the city, across many parts of Texas.
Yeah, makes sense. The post-COVID world where commute to office requirements have hopefully loosened up. So you've gone through all the way, don't go to the office, to go to 2 or 3 days a week to the office, and many corporations are adjusting. Then living in between big cities somewhere, that's been, in New York, that's kind of the name of the game. Just because living in Manhattan is expensive, living in big cities in generally expensive. You can get away half an hour, maybe an hour, and just commute twice a week. It's not bad at all. So from that perspective, it makes a lot of sense. So quick question: do you see the current environment being some kind of, interest rates are high? I'm kind of looping this in. We're recording this episode in the second half of October. And it's causing grief. It's causing grief to a lot of real estate, obviously, on many fronts. But new construction should be significantly impacted because cost to build is cost to build, but cost of money is significantly higher. So do you see opportunities in new construction? Are you investing in new projects? Just curious, what are you doing on that front? Because you have a new build versus value add. It's always tug of war. And of course, it says storage is a huge, it's a supplementary or complementary asset class to multifamily. But if we're talking about multifamily, are you investing, or are you thinking to invest in value add, or are you thinking to invest in ground up? Are you doing anything? I'm just curious, what are you doing today?
Yeah, and I'll answer as an LP. I mean, I'm full disclosure, I'm sure it'll be in the notes. I'm Series 7, all that good stuff. So this is just us talking as LPs here. Two things. One, just from the macro, when you step back a little bit to say what's been going on the last 10, 15 years, but particularly the last 2 or 3 years before rates went up. It seems odd that cash, whether it was in a bond, in the bank, otherwise, was kind of in that 0 to 6% range, going from like cash up to CDs, bonds, and then being an LP and pretty much anything that was value add, you were getting a 20% return. That's a pretty wild delta if you just think of a, kind of just a normal sort of curve. It was almost like a hockey stick versus, I'd say, the 45-degree angle, where today, a lot of folks have their money at their Fidelity account or otherwise at 5 or 6%. Senior debts, some of the corporates out here, you're probably still sub 10. There's a mezz level, and then there's a pref equity. And then, I think there is, to give you a data point for some of us that were out, I think it was Denver this year at Best Ever Conference, Joe Fairless, he has one of the longest running podcasts in our world here, said, as an LP, I've invested in roughly 150 deals, and a quarter to a third of mine are not only pausing distributions, but doing a capital call. And a lot of those were value add. And I know Joe's spread across the country. And once again, this is 6 months ago. So as things have progressed, I think you have to have a little more caution with the value add, because I think call it the modern pro forma and value add, assume free money, assume zero. And that's very difficult these days. And then, looking even on the development side, what's beneficial? Well, if you control the team, the supplies, the cost, sounds like business 101, but there's some benefits here. So I think, once again, I would say two things. One, folks that control the team, vertically integrated, folks that have been through a few cycles before, could be in even prior to financial crisis, even in the 90s, I think is hugely beneficial at this point, for managing, their expectations, their pro forma. And like anything, if there's multiple projects at once, I think that's actually a benefit for a tenured operator. So, and then final point, of course, was talking this at my lunch today, the ability for the operator to be boots on the ground or get to you within a few hour, a few minute or few hour drive, I think is pretty impactful. That gives a peace of mind to, a fair number of investors today.
Yeah, and I appreciate that, Dan. That last comment you just made, it's kind of absolute gold. We don't want to write any fresh checks unless somebody's vertically integrated and local. So the issue at hand is, in the last few years, too many people bought, living in Phoenix, buying a property in Atlanta, and operating with third-party property management. And a lot of sins and errors were forgiven because the market just kind of rose and rose and rose. Now, sharp execution is absolutely critical. If you can't execute well, you can't make all these plans work. And you rightfully pointed out also very, very important, critical, paramount concept, that interest rates set the level of perception. Interest rates is in a matter of speaking, perception of risk. So the interest rates have gone up a lot. And then in a fight against inflation, if you think about this, high interest rate means the perception of risk is a lot higher. So if you're investing in an equity, you better be really well compensated, because 20% IRR today doesn't look the same way as 20% IRR a couple of years ago. So you need to get into projects that either have somehow stronger downside protection through some other mechanisms, or you got to have bigger upside. But what do you think about this counterintuitive thought process? So you have a bunch of people, like you mentioned, who have been caught, they're bleeding, death by 1,000 cuts from existing investments. And this is the reality. Unfortunately, 95% of the value add deals, I don't know the exact percentage, but pretty high, borrowed with floating rate debt. This is how they get financed.
Let me just talk on that as you take a breath. When I look back to see who did a lot of the floating rate, I would say a lot of folks that came into this world over the last five and change years. Why is that? They learned from somebody. It could have been one of these courses you pay $25K to go through or otherwise. And, the pro forma was generally zero. And if you looked at a historic deal from 2014 to 18, rates were the base rate was so low that folks didn't really have this vision that it could be otherwise. And then, as they say, penny wise, pound foolish. When somebody could have locked in fixed at 3 or floating 275. I know shops that I invest with, a very strong number. I think my diligence was off on one deal, but did the fixed debt, because they said, well, 3 can go to 0, but it can go up a lot more. And then, whereas the folks at folks said, well, let me do the floating at 275, realizing 275 can go to 0, but it can go up a lot more. And when it goes up, to your point, it's like an exponential pain and burden that you owe as the operator. So, as I said, it's kind of, the teacher was new, they didn't do the research back. And, some of this is just by factor of age. I always draw a triangle when I think of sponsors. And I think, the bottom, which I like to invest with, you get your gritty sticks and bricks operators, your real savvy financiers, and these two work well together. Top of the pyramid is your kind of, there's sizzly marketer, and you have to be a little cautious sometimes. As you reference, when things are good, everybody wins, not a big deal. But now it's a bit more of a challenge. So a lot of folks, I think, the marketer said, this looks good, and let me talk about the last 3 years, or last 5, or last 7. Without looking to the previous cycle. So, once again, I think, and this isn't just, I'd say, from an age of the sponsor, but you've had other folks that said, hey, I've been in tech for 20 years. Let me have my first deal. Same deal, effectively a novice out versus somebody that's been around 2, 3, 4 decades. So, all else equal, I think being a bit more tenured, also in your geography, in your asset class, is going to be looked upon favorably now by passive investors.
Yeah, thanks for stepping in and providing that color. Exactly. It's funny how you put it. Brilliant marketers on top. I call them the bright and shiny object folks. They just know how to do wonderful marketing materials, and they make the numbers attractive to the investors. And they don't say anything at all about risk-adjusted return. It's all about the top line. It's all about, in the past results, well, this is what things look like in the past. Well, there's a wonderful disclaimer, right? Past results don't guarantee future performance. Past results are not indicative of future performance. Past is in the past. When the pattern breaks, it's almost like this. Everything is fine until it's not. And the longer and more you deviate from the mean, the reversion to the mean becomes more and more painful. So we kind of reverted to the mean, but we reverted to the mean so fast and so furious with Fed waking up that this correction is just unbelievable. It feels extremely painful in the form of what you mentioned: suspended distributions, capital calls, right? Huge uncertainty of what the future value is, because we don't know where the interest rates will settle. If we knew where the interest rate would settle, at least people could price deals. They could estimate what these cap rates will look like, but they don't know. It's almost like this: did the pattern break hard? And now we're a completely new pattern, and we don't know what the pattern is going to look like. We're in a 40 years of declining interest rates. Are we now in a 40 years of increasing interest rates, which would be hard to believe, and I'd love to hear your thoughts on this? Or are we in a temporary adjustment, and we've peaked out on the Fed funds rate increases, and we're going to revert to some level of maybe something in between the ZIRP policy and where we are right now, which feels extreme on a relative basis because it's a rate of change. It's not the absolute number.
Yeah, great. And how I once again, just personal view as an LP here, I think we're at the new norm for a while. What do I mean by that? I remember being back, as a kid in college, my first Roths, doing CDs at the local community bank I worked at, and they were at 5, 6, 7, 8% sort of rates. I definitely might be going a little high, more 5 or 6 for me. I don't remember double digits. My parents do, of course. And, I have some of the little old school bonds on paper when I was born that are towards that. So that said, I definitely don't see us going to 0 anytime soon. That said, I think there's a psychological, and let's call it what it is, there's going to be a lot of political factors here why I don't really figure it going up to 10. So I would say, what we generally experienced in the 90s, in the mid 2000s from a rate perspective is becoming the new norm, which was frankly the old norm for a while, and a relatively healthy. Sure, could it go down a point and that helps a lot of folks? Yeah, absolutely. But generally speaking, kind of, from a base rate, from a, SOFR perspective, kind of mid-single digits, I think that's healthy. I think, historic, when things have been predictable-ish and healthy-ish, it's been around this level. And, both sides of the aisle politically, I don't think they want to see double digits, and even across the globe. Then I think we're in some serious inflationary issues that, could spill over even even worse than what we're seeing now. So maybe I'm a little optimistic here, but I still like where we are now. I think as folks come back in and refresh in 24, post-election in 25, they're gonna be like, okay, this is the norm, so for 5 or 6, let's kind of price things out accordingly. While at the same time recognizing what could be some significant demographic trends. So maybe it's not just back of the napkin cap rate anymore. There's a little more thinking that goes into the price and what revenue can be derived.
Yeah, I appreciate that great view. It's a cautious view. It's uncertain view. It's kind of like we have to be dynamic and see what's going to bring. And this is hard because when you are doing a deal, you're investing in LP or a GP, you want certainty. And certainty is difficult to achieve. This is the biggest issue. What are the future valuations going to look like and when? Simply because you just don't know. Is more inflation, higher interest rates, less inflation? Do you want to buy, do you need to buy deeper? And the sellers are not capitulating. And that's why transaction volume is down. And that's why everything is like in this state of a funk. Like what's going to happen next? And nobody knows. So it's kind of, it's very difficult to write a fresh check. And I was just at another conference, and good friend. He works for Marcus and Millichap. He's a commercial broker for a lot of deals, and he said he's down 70% from last year on transaction volume. And he gave me another comment, which is kind of scary a little bit. And I just want to hear your thoughts on this. So, of course, for the fresh money that gets deployed today, these super good deals, you get a distressed seller, you're a fresh investor, these opportunities should be phenomenal, very strong. At least that's the only deal that kind of transact, at least as a buyer, you want to be only in those deals. And as a seller, you got a situation where, boy, how do I exit these deals? What am I going to get paid for these properties? And if the property is performing, it's not distressed, you still have the buyer's experience. They can't get financing at the rate they used to get. They have to get much lower leverage, much more equity, and it's kind of like, when is the adjustment going to be on the cap rates? Are we going to see significant cap rate expansion for most asset classes that haven't experienced that yet, meaning the price corrections? Because that's the holy grail of in order for things to transact, you need certainty. When you have no certainty, no transactions, can't buy, can't sell, people are paralyzed. So what do you think?
Yeah, I mean, as I said, I think the rest of this year is going to be pretty quiet, and then I felt, I was a little optimistic this year, and I think with Silicon Valley Bank and such in March, it was just enough that it paused some people, 3 months or maybe another 3, and with some of the macro recently to the year. And I know some folks, in an election year, they tend to hit the pause button anyway. So there's going to be a certain crop. At the same time, I think folks that want to be long real estate, that it's a hard asset, particularly on the commercial side, if it is what it is, like a multi, or if it could be repurposed. Think of the old Kmarts that are now self-storage. I think in the big picture here, folks, it goes back to the the neighborhood you're in. So the utility of this property. To give you a micro example here, I had lunch with a friend today, and she owns a beach condo, bought it around COVID, and is looking to flip it. And she's like, it was great because during COVID, we can work, we can do stuff. We're not seeing many interested buyers at the moment. Not a surprise. Fourth quarter, folks have gone home from the beach, so they're not dreaming about it and such anymore. But I suggested, I'm like, hey, you and your husband and kind of your sons were effectively working. Why not offer this almost as like, a mini sort of WeWork, instead of a short-term rental during the summer, or both, frankly, because it's your space. Where they are in Texas, the zoning, that's something you probably could do. So this is a very micro example where I think whether it's these guys are going to increase the rent and then over time increase the value, or a buyer is going to come in that is local, boots on the ground, that can manage it. It's not a far away sort of rental. I think you're going to see some of that from the one-off, and folks want change. As I said, it's probably going to be the calendar change in January 1st, where people say, okay, here's mortgage rates, here's this, but this is what I need for my business, for my lifestyle, and this is where we're going to. So that's just some local micro that I've picked up from conversations here in Austin, in Houston. and anything, rest of the country in terms of, I invested in a fund, a gentleman, he looks at smaller multifamilies, 20 to 40 doors in Pittsburgh, in Cleveland, across the Rust Belt. And, the cap rates don't have to correct, but they've been in the 7 to 10 range recently, and they haven't changed since rates have gone. So, with that, there's a lot of money on the sidelines that has to do something. A final point just to share on this. I think the ability hey, buy Vegas for $1. I think enough people, even if they're in a tough situation, they know to do a Google search or get a broker or put something out there to get enough bids. Whereas instead of being forced to sell at 20, 30 cents on the dollar, they might be closer to 80 or 90 just because there's so much money on the sidelines that wants to do stuff. So I think the net effect is there could be some drops, but frankly, from 2020, you're probably still in the green a little bit. Is kind of what I'm seeing here locally.
That's an interesting view. Yeah, I appreciate that. It's kind of like, on one hand, we're expecting to have blood in the streets. On the other hand, so much money is waiting for the blood, and is it going to be a waiting game, or as soon as some little bit of discount becomes available, that money comes in? The other quick comment I have, love your comment on pickleball, and I saw a repurpose of all these dysfunctional malls when I was in California, actually, at a conference. We had a 6:15 a.m. trip to a pickleball courts, and they were inside of an old mall. So there's definitely those opportunities that are taking place, and if you are a local investor, you could actually see whatever that is. Makes a lot of sense. Dan, I appreciate your wisdom. What's the best way for folks to reach out? They have follow-up questions, whatever you're comfortable to share, but if they wanted to connect, ask you some questions.
LinkedIn is great. And, please reference that you heard it on the Big Mike Fund podcast. And then this is a lot of letters here, but dan.krzyzanowski@bbcapitaltx.com is an email also. But I tend to be regular on LinkedIn. Love to continue the conversation.
Yeah, I appreciate that. Let's make sure we get this in the show notes. At least there's that email. By the way, I will give you a little feedback here. Like, if you have a long name, come up with something like I have bigmikefund.com, right? It's just like, come up, dankay-something.com, or come up with something like really, and it works. People, it's easy to remember.
It's funny. My first consulting website was, dankay.com. And then my friend looked at me, he's like, that's dank. And I'm like, thought back to my college days.
I didn't think about that.
So, I paid $7 for a domain. It happens. But, I, at least here with my, my 7-year-old, I'm going to be Coach K. I'll be known as Coach K on the basketball court, which I feel is a pretty good one after our, the retired coach at Duke. And, so we've played with the letters a lot. And my son has it a little bit better. His initials are ARC. So it's kind of a good one to play with. Yeah,
you could talk to coachk.com, right? So something like this, and if it's available, makes sense. So good luck with that.
Share. Thank you.
Appreciate you coming on a podcast. Appreciate you sharing the wisdom, and best of success in your investing journey. Hopefully you will see some great opportunities and don't see too much blood in the street. It's almost like this, because we wear both hats. We manage, obviously, portfolios of assets, and within our funds and syndications, we don't want to see blood in the streets. We want to deploy fresh capital. That money needs great opportunities. But the challenge is just unknown. Most of us, and one more comment on the kind of steady Eddie Midwest. That's why I love Midwest. You don't see that yo-yo behavior. You don't see this volatility in the cap rates. And if the assets are fundamentally solid, it's only financial dislocation as a matter of a few years in theory. But we'll see. We'll see what happens. So Midwest should be steady Eddie. Even cyclical markets, well, they call Austin a cyclical market. It was a rapidly growing market. It's been some correction in Austin, but what's going to happen on a forward basis, right? Maybe it's still a rapid growth, just with a little bit of an adjustment, right? So, thank you.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to bigmikefund.com or visit Amazon and type Mike's Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.